Ever wonder how some investors always seem to be one step ahead? How they manage to scoop up the right stocks at the right time before everyone else catches on? Well, it's not magic, it's not luck, and it's definitely not guessing. It's access, it's research, it's data. Legendary investors like Warren Buffett, Bill Ackman, Michael Burry, Howard Marks, and Mohnish Pabrai have teams of analysts, decades of experience, and the discipline to wait for the right pitch. But here's the good news. We get a peek into what they're doing. Every quarter, these fund managers are legally required to disclose their trades through something called a 13F filing. And their latest filings? They're loaded with clues. And that gives us a massive edge, if we're paying attention. In this video, I am breaking down 6 stocks that billionaires are buying right now. I am not just going to list them. We'll break down the why behind each one, the financials, the strategy, and whether you should be adding it to your portfolio. Let's get into it. First off is Warren Buffett's pick. In his most recent 13F filing, one position stands out as both calculated and deeply thematic: Lennar Corporation. As one of the largest home builders in the United States, Lennar is a company with enduring fundamentals and a business model rooted in necessity. Buffett's long-standing preference for simple, essential businesses with strong economics makes this a fitting choice. In a market where sentiment toward the housing sector is mixed, pressured by high interest rates, construction costs, and affordability issues, Buffett is clearly betting on long-term supply-demand fundamentals and the resilience of the American housing story. Lennar's business is straightforward, yet powerful. It builds and sells homes, primarily in high-growth markets across the U.S., including the Sun Belt states. But more than that, Lennar integrates land acquisition, development, and construction, offering full-stack control of the value chain. That integration not only protects margins, but also allows the company to adapt pricing and inventory to match regional economic conditions. With a chronic housing shortage still gripping the U.S., particularly in entry-level and mid-tier segments, Lennar is positioned as a prime supplier in a structurally undersupplied market. Financially, the company has shown both discipline and adaptability. Over the last 5 years, Lennar's revenue has steadily grown from $22.5 billion in 2020 to $35.4 billion in 2024. This isn't just growth for growth's sake. The bottom line tells the same story. Net income climbed from $2.47 billion to $3.93 billion over the same period, a near 60% increase, underscoring strong operational efficiency despite inflationary headwinds in materials and labor. Operating margins are solid at 12.0%, while returns on equity and capital, 17.9% and 16.9%, respectively, reflect a well-managed, capital-efficient model. One of the most telling aspects of Lennar's strength is its balance sheet. As of the latest fiscal year, Lennar reported net debt of negative $720 million. That's not a typo. The company has more cash than total debt. In a capital-intensive industry known for leverage, Lennar's ultra-conservative capital structure is a strategic asset. It gives the company flexibility to reinvest, buy back shares, or weather economic downturns without risk of overextension. The debt-to-equity ratio stands at just 0.2, and interest coverage is extremely high, with a staggering EBI to interest ratio of 225.9 times, meaning it earns over 200 times what it needs to cover its interest payments. In simple terms, that's how easily a company can handle its debt costs using its operating profit. Valuation-wise, Lennar looks attractive by almost any traditional metric. It trades at just 10.7 times trailing earnings and 7.4 times EV over EBITDA, even as it generates double-digit returns on capital and consistent free cash flow. While forward-looking growth metrics have cooled slightly, with EPS and EBITDA expected to dip in the short term, the longer-term trajectory remains intact. 10-year EPS growth has averaged nearly 14.7%, and revenue has compounded at 15.1% annually over the same stretch. Ultimately, Lennar fits squarely into Buffett's core investment philosophy: a durable business selling an essential product at a fair or even discounted price, with strong financials and long-term tailwinds. The U.S. housing story remains compelling, especially for a builder with Lennar's scale, discipline, and geographic reach. This isn't a flashy pick, it's a patient one, And as always, Buffett is playing the long game. Next up is Bill Ackman, whose latest move signals confidence in one of the biggest names in tech. Ackman's recent addition of Amazon to Pershing Square's portfolio was a calculated bet on a company that's more than just e-commerce. It's a sprawling tech infrastructure giant, a consumer ecosystem, and a free cash flow engine in the making. Amazon is, by any measure, a behemoth. With a market cap of $2.46 trillion and over $630 billion in revenue, it commands scale and pricing power that few companies can rival. But it's not just the size that's attractive. It's the acceleration in profitability and operational efficiency that's likely caught Ackman's attention. Net income more than doubled year over year in 2024 to $59.25 billion from $30.43 billion in 2023. EBITDA rose by over $34 billion in the same period, now standing at $123.81 billion. These signal a fundamental shift in Amazon's profitability profile. The standout story here is free cash flow. In 2022, Amazon burned nearly $17 billion. In 2023, it swung to $32.22 billion positive, and that momentum continued into last year with $32.88 billion in free cash flow. That's a dramatic turnaround that shows how operational leverage is finally kicking in after years of aggressive investment. For a long-term investor like Ackman, this kind of shift is gold. He's not just buying into a stable tech name, but one that's at an inflection point. On the valuation side, Amazon isn't cheap, trading at a price-to-earnings ratio of 35.2 on a trailing 12-month basis and a price-to-free cash flow ratio of 182.8. But this isn't your typical earnings multiple game. Growth metrics tell a more nuanced story. Over the last decade, Amazon has grown revenue at a 21.5% compound annual growth rate and earnings per share at 78.2%. Those numbers are staggering for a company of its size. Even forward-looking estimates remain strong, with EPS expected to grow 17.0% over the next 2 years, and long-term EPS growth estimated at 18.0%. So it is safe to say Ackman isn't paying for past performance, he's paying for what's to come. Balance sheet strength adds another layer of confidence. Amazon holds $101.2 billion in cash and has reduced net debt to $52.1 billion, down from $62.2 billion in 2023. While total debt remains high at $130.9 billion, the company's ability to generate over $115 billion in annual operating cash flow provides ample cushion. The debt load is more a function of capital structure than financial risk. What makes Amazon an Ackman stock, though, is the convergence of multiple moats. AWS remains the undisputed leader in cloud infrastructure with high-margin cash flow. Prime has locked in hundreds of millions of consumers. And with advancements in AI, advertising, and logistics, Amazon is building optionality into every corner of its ecosystem. This isn't a growth-at-all-costs company anymore. It's a leaner, more disciplined cash-generating machine. Now we move from big tech to bold retail. And a surprising high-conviction bet from Michael Burry. When Michael Burry takes a concentrated position, it's rarely a surface-level bet. His selection of Lululemon as a top allocation is a calculated contrarian play, one that blends deep value instincts with the recognition of brand power and operational excellence. While the broader market has pulled back from high-growth retail names, Burry's interest in Lululemon signals confidence not just in the company's earnings potential, but in its long-term cultural and financial moat. Lululemon is not your average apparel company. With a $24.4 billion market cap and revenue of about $10.6 billion, it has carved out a premium niche in activewear. The company's gross margin of 59.3% is exceptional in retail, reflecting strong pricing power and brand loyalty. Notably, EBITDA margins stand at a healthy 27.7%, while net margins hit 16.8%, both of which speak to Lululemon's efficient operations and disciplined cost structure. From a return perspective, the numbers are eye-catching. Over a 5-year average, Lululemon posts return on equity, ROE, of 38.1%, a return on assets, ROA, at 22.3%, and return on invested capital, ROIC, at 35.4%. These numbers are best in class. Such consistent returns suggest a business that can reinvest capital at high rates, a trait Burry has often emphasized in his investments. What's more interesting is the company's growth trajectory. Revenue has climbed steadily from $4.4 billion in fiscal year 2021 to $10.6 billion in fiscal year 2025. Net income has also grown threefold over this period, from $589 million to $1.81 billion. Diluted earnings per share have compounded at over 22% annually over the past 10 years, supported by both top-line growth and operational leverage. Even if earnings growth moderates, the long-term compound annual growth rate of 10% in EPS expectations remains respectable and realistic. On the balance sheet, Lululemon is in stellar shape. Total debt sits at $1.58 billion, but the company holds $1.99 billion in cash, resulting in negative net debt of $408 million. The debt-to-equity ratio is just 0.4, and interest coverage is not even listed, likely due to minimal or manageable interest obligations. This strong financial footing gives Lululemon a level of flexibility rare in the retail space, especially during uncertain macroeconomic cycles. Free cash flow has consistently improved, rising from $574 million to $1.58 billion. Operating cash flow has similarly expanded to $2.27 billion. These figures show not just accounting profitability, but real cash-backed earnings, something Burry prioritizes. Despite near-term stock volatility and margin compression in some quarters, Lululemon's fundamentals remain robust. Its valuation is modest, trading at around 13 times earnings, a far cry from the sky-high multiples many other growth names demand. This relative discount may be what drew Burry's eye, a high-quality, profitable brand growing into a more attractive valuation. Next, let's look at Howard Marks' position in Barrick Mining, a move rooted in value and stability. Howard Marks rarely buys a high-flying momentum stock. Instead, it's almost always a bet on value hiding in plain sight, and Barrick Mining fits that mold perfectly. As one of the world's largest gold producers, Barrick has the kind of defensive profile that appeals to Marks's playbook: cash flow, generative, undervalued, and built to weather economic turbulence. But there's more to this position than gold alone. Let's start with the core thesis. Gold is a classic inflation hedge, and with rising interest rate volatility and macro uncertainty, institutional investors are returning to it as a store of value. Barrick gives exposure to that dynamic, but with a twist. Unlike buying physical gold or ETFs, Barrick offers operating leverage. When gold prices rise, miners' profits often rise faster, and that's exactly what this bet is about. On valuation, the story begins to sharpen. Barrick currently trades at just 14.9 times earnings, well below the broader market average. Its forward price-to-earnings ratio is even lower, around 9.1 times, suggesting a meaningful earnings recovery is expected by analysts. The enterprise value-to-EBITDA ratio is just 7.0 times on a trailing basis and 4.2 times forward, a steep discount for a company with close to $13 billion in annual revenue and strong free cash flow margins. Speaking of cash flow, the business has been increasingly efficient at converting revenue into cash. In 2024, Barrick generated $1.32 billion in free cash flow, more than double what it managed the year prior. EBITDA also jumped significantly, from $5.16 billion to $7.01 billion in 1 year, on the back of stronger margins and cost optimization. Gross margin stands at 44.0%, with an EBITDA margin of 51.1%. Very impressive figures in a traditionally capital expenditure-heavy industry. Financially, the company's balance sheet is in solid shape. Net debt sits at just $1.19 billion, manageable for a business of this scale, and the debt-to-equity ratio is only 0.1. That means the company isn't over-leveraged, giving it room to maneuver if macro conditions change. With $4.07 billion in cash and short-term investments, Barrick has enough liquidity to invest in projects, pay dividends, or withstand gold price downturns without scrambling for financing. Yet what likely attracted Howard Marks even more is the long-term outlook paired with the current sentiment gap. Over the last decade, gold mining stocks have struggled to keep pace with broader equity markets. Barrick's stock price reflects that, down significantly from its highs. But the fundamentals are improving. Forward earnings per share is projected to grow over 41% in the next 2 years, and long-term EPS growth is estimated at 33.5%. This means the market might be undervaluing Barrick's earnings power in a rising gold environment. In true Marx fashion, this is a contrarian play with patience built in. Barrick isn't exciting to most retail investors right now, but that's precisely why it's interesting. With a reasonable valuation, rising cash flows, low debt, and exposure to an asset class regaining favor, this is a classic Howard Marks setup. Value meets timing, and the upside is tied not to hype, but to mean reversion and macro hedging. Next is Mohnish Pabrai's latest position, one that leans heavily into a deep value contrarian energy play. Mohnish Pabrai's investments are rarely about what's hot right now. It's almost always about what the rest of the market has left for dead. His investment in Valaris, the offshore drilling giant, is a classic contrarian play. A distressed cycle bet plays squarely on a sector most investors have been running away from. And yet, that's precisely what makes this one worth watching. Valaris operates in one of the most cyclical and capital-intensive industries on the planet: offshore oil and gas drilling. For years, this sector has been in a downward spiral, victim to volatile oil prices, ESG divestment trends, and a decade-long underinvestment by the majors. But now, as energy demand stubbornly climbs and geopolitical instability adds risk premiums back into oil pricing, Pabrai sees an inflection point few are daring enough to bet on. He's not betting on oil, he's betting on the rig owners that survive the storm. And Valaris fits the bill. A look at the company's numbers shows the turnaround is already underway. Revenue grew from $1.78 billion in 2023 to $2.36 billion in 2024, an increase of nearly 33%. Even more impressively, earnings before interest, taxes, depreciation, and amortization more than doubled in the same period, jumping from $254.4 million to $577.1 million. Net income, which had been negative just a few years ago, came in at $373.4 million in 2024, a dramatic swing from a loss of $4.5 million in 2021. This shows that operational leverage in offshore drilling cuts both ways, and Valaris is now riding the upside. The balance sheet also tells a cleaner story than one might expect. Total debt stands at $1.17 billion, with net debt at around $799 million. Manageable levels for a company with over $2.2 billion in equity and $4.4 billion in total assets. Importantly, the debt burden isn't climbing with growth, it's shrinking relative to earnings. Operating cash flow jumped to $355.4 million, up from $267.5 million the prior year. And while free cash flow remains negative at negative $99.7 million, it's clear the business is reinvesting heavily to meet rising demand. Pabrai's style is to buy what others fear, and offshore drilling has long been synonymous with risk. But what's changed is the supply dynamic. Years of underinvestment mean there's a growing mismatch between exploration capacity and energy demand, especially in emerging markets where oil remains a foundational resource. Valaris, with one of the largest offshore fleets in the world, is positioned to capture this demand, and its recent earnings show it's already happening. The broader market may still be cautious, but the fundamentals are aligning. Improving profitability and a dramatically rising bottom line suggest that Valaris has moved from surviving to thriving. Pabrai's thesis likely hinges on mean reversion, not just of energy stocks, but of valuation multiples across neglected sectors. Lastly, I have United Health, backed by both Buffett and Burry, and one of the most defensible businesses in the market today. When both Warren Buffett and Michael Burry agree on a stock, investors should take notice. Despite their vastly different styles, Buffett's long-term value discipline and Burry's deep contrarian instincts both have found a compelling case in United Health Group. This convergence suggests a rare conviction in the fundamentals of a company that remains a juggernaut in the healthcare sector. UNH isn't just a healthcare provider. It's a vertically integrated behemoth that has steadily grown through a mix of acquisitions, expanding insurance services, and technological innovation in care delivery. At the heart of this dual conviction is consistency. United Health has maintained remarkably steady top-line growth, even in a challenging economic environment. In the most recent fiscal year, revenue climbed to $400.28 billion, marking a strong trajectory from $257.15 billion 5 years ago. That's a compound annual growth rate of around 11.3%. Impressive for a company of this size. More importantly, profitability has kept pace. Net income, while down year over year to $14.40 billion, still reflects a healthy 5% net margin and a 5-year trend of earnings resilience, with returns on equity and capital, ROE at 21.4%, ROCE at 18.6%, suggesting this is a business that turns capital into cash at an elite level. On the valuation side, United Health currently trades at a trailing price-to-earnings ratio of 11.7 times, well below many of its healthcare peers, and its forward PE of 16.7 times remains reasonable when considered against its consistent earnings growth. The market may be discounting some near-term headwinds like regulatory overhang or short-term reimbursement pressure, but both Buffett and Burry seem to be playing the long game. This is further supported by a price-to-earnings growth, PEG ratio, of negative 0.3, which may look odd at first. The PEG ratio compares a company's price-to-earnings ratio to its expected earnings growth rate, offering a way to assess valuation in relation to growth. A lower PEG typically signals a better value, but in mature, high-cash flow businesses like United Health, it can be distorted by temporary earnings shifts or conservative forecasts. The real signal here isn't the number itself, it's the combination of value and durability the stock represents. What likely appeals to Buffett is United Health's strong free cash flow profile. Last year, FCF reached $20.7 billion, which supports not only robust dividend payouts, $9.00 per share, yielding 3.3%, but also consistent share buybacks and reinvestment. The company's payout ratio is conservative at 36.6%, leaving ample buffer for future hikes or acquisitions. For Burry, who thrives on asymmetric risk-reward setups, the defensive nature of this business, combined with its market-leading position and undervalued multiples, likely signals safety with upside. Even amid margin compression and cost pressures, United Health throws off cash and maintains a lean balance sheet, with a debt-to-equity ratio of 0.8 and over $29.1 billion in cash on hand. Despite a recent pullback in stock price, from above $500 down to $3, the fundamentals remain firmly intact. The current valuation offers a rare entry point into a company that still leads its sector by miles. Growth may be slowing, as seen in some of the forward earnings per share projections, but durability hasn't wavered. This is why both Buffett and Burry are circling. It's a wide moat compounder on sale. Warren Buffett may have bought a couple of stocks, but he also sold over $6 billion worth of stocks. Click the video on screen to see which ones and why.